All right, today we're going to talk about dividends and whether buying high dividend stocks is a viable or interesting strategy. What are dividends? Why do companies pay them? And should we seek them out? So, a dividend is money that is distributed from a company to an investor. Not every publicly traded company pays a dividend. About half do, as do about 3/4 of the stocks in the S&P 500. Now, the dividend yield is the percentage of the share price that the company pays out as a dividend. And on average, it is about 2%. I don't know why I wrote number one. On average, it is about a 2% dividend, but you can find stocks that pay, 6%. You could sometimes even find an 8% dividend, but on average, it's about 2%. So the way this works is that if you have a $1,000 stock that pays 2%, you would be paid out $20 annually over the course of the year, assuming the stock stays flat. It's not typically paid annually. Often it's paid quarterly, but over the year, you would be paid $20. Usually the payment is made in cash, but you can choose to reinvest the dividend to get additional shares. And that's typically what I do with dividends. The distributions are, again, as I said, made quarterly. And in order to be entitled to a payment, you have to have held the stock before what is called the ex-dividend date, which is the day the stock starts trading without the next dividend payment already baked into the price. Boards of directors typically decide dividend amounts. Now, why do some companies pay dividends and others don't? You might recall one of our recent segments, we talked about growth versus value stocks. And you may recall that growth stocks are companies that want to expand and innovate. Value stocks tend to be more established companies that are churning a consistent profit. Growth companies want that excess capital to keep growing. So if there is excess capital in growth companies, they are more likely to reinvest the money back into the company. Value companies are more likely to focus on rewarding shareholders and delivering a profit. So value stocks are more likely to pay dividends than growth stocks. A company may pay a dividend to send the message that we are financially stable, that the company is worth investing in, that they can deliver a solid stream of income to shareholders. Now, it is important to understand some of the details about how dividends work. You might be hearing about dividends and think, great, I should just find companies that pay the highest dividends, buy all of those, and I will be guaranteed a high return. Because think about it. Look at these numbers. If I can find companies 6% dividend, 8% dividend, that's unbelievable. I'm guaranteeing a return. Plus, in addition to this, I've got the stock price appreciation over time. I'm going to get 7% on appreciation and 7% on dividend. It's going to be unbelievable. No, not the way it works. A high dividend payment sort of bakes in the reality that the company won't be able to grow its valuation that fast because it's using so much of its cash to pay that 6 or 7 or 8% dividend. And in fact, the dividend payment can be a drag on the valuation because the value of the company decreases when these distributions are made. If the company pays out a 2% dividend, the stock price is expected to adjust downward by 2%. So the question is it a good trade-off to decrease valuation for the money being added to your account every quarter, either reinvested or paid out as cash? That's a question to consider. There are lots of high dividend stocks out there that are paying a high yield. But if you look at how they've performed over the last 5 years, they might be down 33% in some cases. AT&T, Hasbro, Simon Property Group are some examples. In contrast, there's a ton of stocks out there that pay modest dividends or no dividends, and they've stood the test of time. Coke pays a lower dividend. Apple pays a lower dividend. Now let's talk about the tax implications here, because that's also a factor in your return. As long as you have a qualified dividend, meaning you meet the holding requirements, you're taxed at the long-term capital gains rate. Those rates are 0, 15, and 20% right now. If you don't meet the holding requirements for the year, the dividends are taxed as ordinary income, which for most people is higher. Even if you reinvest the dividends to get more shares, you still need to pay taxes on them. So in a way, it's a forced sale and forced taxes that you could conceivably delay if the company didn't make those dividend payments. So the tax component is not trivial. So proponents of dividends say, solid stream of income, you know what you're reaping in terms of rewards from the business. Those against wonder, is it really worth those consistent payments because it's decreasing the valuation and there's a question about tax efficiency. As for the question, does it make sense to seek out individual stocks or funds that pay the highest dividends? Probably not the best strategy, and hopefully you can now see why.